everyone. Is the microphone in the right position? Can you all hear me? I have to always put it up. Excellent, very good. So my pleasure to be here. Daniela, thank you for the invitation, and Karel, thank you for the very good opening. And thank you also for being willing to listen to me sharing my ideas about the ESG within the regulatory and supervisory framework for insurance. And this is, I think, an important moment in time with one commission almost leaving the podium, elections coming, and a new commission coming in, and a lot of events happening and climate change happening in around us. And there's no reason, I would say, that you need to visit Vienna. I grew up watching the Sissi movies with my grandmother, and since I always find it a magical city. But it's also good to be invited to speak with you, and then I'll be here for the coffee break and the lunch, and to discuss these topics. It's these moments when I meet with stakeholders and colleagues that I actually get inspired to keep going and maybe also to make some changes sometimes. So I look forward to that. I think Karel already alluded to it. If you look around us, then there can be many reasons why we would be pessimistic. There's no shortage of very bad and alarming news. I think many of us experienced a very warm weekend, and now all of a sudden we're back in autumn. But there's also other issues, political issues, geopolitical issues, societal issues. And it's tempting, not unavoidable, but it's tempting to think that things are only getting worse. A number of crimes, people living in poverty, fewer young people having quality educations, particularly girls. I can name a lot. Now, there's an award-winning Swedish physician, Hans Rosling, and he argued in his book Factfulness, and I can recommend that the world isn't in a bad shape, at least not as bad as we think, because he took a thorough look at the facts himself and showed that we actually starkly also underestimate sometimes what we can do if we set our mind to it, if we look at the facts, if we act. And our predisposition to focus on negative news sometimes leads us to be overly pessimistic about the state of the world, and also to be too pessimistic on what we can achieve. Now, how does that relate to ESG risk and to the environment? Well, let's start with the bad news. There is negative news. Negative news travels fast, but the numbers do show that the impact is rising. And we see that in the last over 40 years, so since 1980, the total damages in the EU were around 650 billion. But only in the last 2 years, that was 85 billion. And if you do a statistical analysis, you see that on average, in the last 10 years, the increase of damages was 2.5% per year. And that is a trend that is currently persisting. So that means there's a lot more coming. And figures collated by Munich Re show that the number of natural catastrophes have more than tripled over these 4 years. And Swiss Re found in a paper last published that the total direct economic losses amounted to 300 billion globally in 2023. And I can go on and on mentioning these numbers. So evidence overwhelming, unrefutable, but it doesn't mean we can't do something. It doesn't mean we need to be pessimistic, certainly not. It means that we need to get to work more than ever, and we need to see what we can achieve. I grew up as a teenager when we had acid rain. That is no longer a problem. We dealt with it. We have other problems, but we are capable of dealing with issues if we really have to. And in this case, we really have to. And we're by no means alone in this. Insurers themselves, you are making valuable contributions to the fight against climate change. Just now I didn't raise my hands. I think you can do more, but I'm not saying you're not doing anything. And while the realities of our time force politicians to also focus on our sovereignty, on the events, it doesn't mean we can let go of sustainability. So what do we need to do? We need to do 4 things. I'll discuss 4 things. We need to inform, incorporate, invest, and incentivize. Inform. The fight against climate change starts with collection of reliable, accurate, and actionable information. That's what insurers do. That's also what supervisors are doing. And it's necessary so we can measure the risk, understand where defenses are lacking, predict losses, and help with modeling to do that, price the policies appropriately you need to price for your risk, and then develop strategies to lower the exposure through mitigation and adaptation. Now, very good climate data and modeling is difficult to come by, and they're often very pricey, but we are improving. And to make sure that insurers, large and small, have access to both data and modeling, EIOPA has resolved to provide quality data and tools in an open source format, and we do so free of charge, and you can find that on our website, and we will continue to do this. Our natural catastrophe dashboard that we developed, as well as our collaboration with Climada to offer a user-friendly catastrophe modeling tool, and our latest data hub for NatCat data that was released on insured losses are some examples of what we do open source for the wider community. We will be taking up the issue of comprehensive data collections on losses and exposures also with the next commission, so that we can share even more in the near future. For data collection is essential, and at the same time, it is important not to stop there. And a strong pillar of EIOPA's role in sustainable finance is turning information we already have into insights for the sector we supervise. And so in this vein, we have also published informative analysis on asset side transition risk as well as climate-related physical risks for insurers. We've also conducted a climate stress test for occupational pensions last year, and we will be participating in the joint stress test exercise together with the ECB, EBA and ESMA for the entire market, that is on the impact of the Fit for 55 package of the Commission. So that's focusing top-down on transitional risks. And then finally, we have started exploring the implications of biodiversity loss, the next step after climate, and even more complicated. Estimates of financial damages related to biodiversity range from 1.7 to 3.9 trillion annually. Here we are studying how the insurance sector can contribute to the restoration and conservation of nature through investment, but also through underwriting. Then incorporate. All the work that we've done so far has only underscored that climate risk is unmistakably relevant for insurance. And yes, there's also a whole discussion on how you can change the world, but I hope you hear that we as supervisors, we see that role, but we focus on the risks that you need to manage as a company, and also as managers of society's risks. Both transition risk and physical risk can for sure become material. And so in order to maintain the stability of the sector and to make sure that insurers can continue to provide vital services to households and businesses, even in the face of mounting climate risk, the next logical step is to incorporate the learnings we have into risk assessment and the prudential framework. And one way to do that is via the own risk self-assessment, the ORSA, so that insurers themselves have more clarity on the risk they are exposed to and also how they want to deal with that. To help insurers incorporate climate change risk in their risk assessment, EIOPA published a very bespoke application guidance on materiality assessment and climate scenarios. And the fact that we call it application guidance is very relevant. For first, we called it guidance, but then we got feedback from those who are already more advanced in the industry, and they said, we're already doing this, and we're doing it slightly different, and if you now want us to implement guidance, that is actually hindering our process. So we changed the wording, we said application guidance, and that means that you can use it if you want to, because there were many also supervisors who were asking us for this guidance, but at the same time, if you are already on the move, keep going, share lessons, and let's do this together, maybe in a different way. But there are, in Dutch we say, but hopefully in many languages, there are many ways that lead to Rome, and that's where we need to go to. So what we saw back in 2021, only 13%, 1/3 of the ORSAs was actually referencing to climate change risk scenarios. And that is not enough, of course, given the risk that is really there. So we currently followed up on this because the ORSAs that came in now for last year actually they need to include the ORSA. And so let's see how that went, what lessons can we learn, how can we further improve. And another inlet for including climate risk in insurance risk management is through the standard formula for solvency capital requirements. Here, certain hazards such as flood, hail, earthquake, windstorm, subsidence, that is ground sinking, have already been included. But a few weeks ago, we completed a reassessment exercise of the NatCat risk module, where we looked at whether risk factors that we allocated to these perils, so to earthquake, to hail, to windstorm, are they still relevant in each member state in view of the latest data? And I think this review of the NatCat risk module is very relevant with more and more data coming in, but also more risks showing up in different countries. And we actually had to end up readjusting factors in 16 cases. And of these, 12 were moved upwards. For example, flood for Belgium was moved up. Hail in Luxembourg was moved up. Windstorm in the France overseas territories were doubled. And beyond reassessment, we also are proposing to actually include additional countries for perils that volunteered. For example, the Nordics and Ireland, but also my home country, the Netherlands, indicated that they would like to be included in flood risk. And we're also considering and consulting on whether future perils would need to be added, such as coastal floods, maybe wildfire, maybe drought. And I can only encourage you to participate in a consultation and give us feedback on this. Fighting climate change is a common effort, and the rulemaking around it should be based on a large sample and should be also based on diverse thinking, as diverse as possible. And we're united in diversity in the EU, and I'm counting on all feedback to make sure that we are also considering that when we make these proposals. That's the NatCat risk module. There's a third element, and that is the question how regulation could treat assets and activities that are associated with environmental and social objectives and thereby harm them. So the risk differentials, or often referred to as green or brown assets. At the core of this is whether insurers need to assign more capital to assets and underwritten business that is riskier from a sustainability perspective, and if we can do that in a future-proof way. Now, we consulted on this topic in late March, and the consultation, the jury is still out on how we'll proceed on this file. I'll still need to discuss this in my board. But one thing is certain, our approach is strictly risk-based. And what you've seen is that we've opted not for a Pillar 2 approach, which is different from banks when they do opt for a Pillar 2 approach. And that led to some discussion also in my board with my 27 supervisors, some of which are also supervising banks. But the rationale behind that is if we quantify in Solvency II, we only do that in the first pillar. So if you want us to quantify these risks, then that should be done in a first pillar. In the same vein, we're not saying brown, we're also not saying green. We're saying risk. And I always say the logic there is that also for our health risk module, we don't say healthy or unhealthy. So why for sustainability risk should we say brown or green? But what we do see is at least based on the data and the data and the methodology that particularly for fossil fuel in the market risk module for stocks and bonds, there would be an argument to include that in the Pillar 1. I'll go to the third topic, invest. After highlighting the importance of information about climate change, there is also the point of investment. The European Commission and the European Environmental Agency estimate that Europe needs an additional 480 to 520 billion annually to meet the 2030 goals. And many are talking about how insurers then can help that transition by investing in it. Private investments in future-oriented sustainable products are indispensable to reduce our dependence on fossil fuel. And long-term investors like insurers and pension funds are best placed to do that. Insurers and occupational funds in the economic area have a combined balance sheet of well over 10 trillion in euros. And a previous analysis by EIOPA has shown that only 2.6% of insurers and 4.5% of occupational pensions funds are in corporate bonds and equity holdings that are aligned with the taxonomy. Was I shocked by that number? No, I wasn't. We're at the start. Green transition is about becoming green, not about being green. And so the fact that it's currently a low number means that we still have a lot of opportunity to improve and see how we can better align investments with the taxonomy. It's the start, it's a challenge, it's also an invitation. The share of the sustainable investments should, of course, in the end, increase substantially. But to allow this to happen, we need to have more clarity and transparency on the reporting. And here we have the SFDR. It has been instrumental in this regard as a frontrunner in the financial sector, as has been the CSRD, the Corporate Sustainability Reporting Directive. The first disclosures will be coming out early next year for those included in the first phase of the CSRD, and more will follow gradually. We have been advising the Commission on the underlying sustainability reporting standards and made a strong case for greater compatibility and comparability across the different reporting requirements, including SFDR and the accounting standards like IFRS 17. We're conscious of the reporting burden on financial institutions, and our intention is that when we implement, we should make reporting smarter and more efficient and not more. And this is why I did not raise my hand when we were asked if supervisors already do everything they can. So together with EBA and ESMA, we have been involved also in the review of the SFDR disclosures, and we are drafting an opinion at the moment. Now, I cannot already tell you what is in that opinion, but we are making efforts to make it easy for consumers to understand products. But I can also say that we are seriously thinking about labels, or what we call categories, that make Article 8 better to understand. And with that, let me transition to my final topic, and that is incentivize. The beauty of insurance, and something that fascinates me to this day, is that it takes risk that is too large for an individual or too large for a company to carry, and almost invisibly deals with it across a pool of clients, across borders, across many parts of the world with reinsurance, and it converts the risk of potentially debilitating financial losses into manageable regular payments. Isn't that fascinating? That's what you do. In other words, it does not overall reduce the risk in total, but it makes sure that as a society we can manage that risk together. Now, Europe really faces an acute natural catastrophe protection gap. 75% of losses stemming from natural disasters, like earthquakes, floods, and wildfires, are currently uninsured. They're not insured for. And the risk is only getting bigger. And there's a lot we can do and should do. So with the ECB, we've worked on our advice that came out last year, where we actually show that not only insurance can act, they should, but also governments should act, also individuals should act, also reinsurance, capital markets should act. And what happened in first was insurance saying, this is not going to work anymore. The number is too large. And governments were ignoring it. We're now at a point where governments no longer ignore it because they see that the damages are going up too fast. And consumers are really often only relying on government. Our behavioral study showed that besides thinking it's too expensive or it won't happen to me, which is common, there is also a big reliance on the state will help me if it happens. But states can't keep up given the numbers that are coming. So what we will do going forward is we will work further on that and find ideas on how we find creative solutions, not only to share the risk, but also to reduce it. So mitigation, adaptation will be essential. And that means that insurers should say, we can insure if, and then there comes a condition. And we call that impact underwriting. With impact underwriting, insurers can steer policyholders towards reducing risks in many ways. Risk reduction models can contribute to keeping insurance available and affordable in the face of climate change. And maybe sometimes if insurers can't do that, maybe if insurers really have to charge a really high price, maybe that price in itself is a signal that that activity should not take place, or at least not take place there. Maybe you shouldn't build there anymore. Maybe, and that is a difficult discussion, maybe we should have that discussions. Some regions maybe have already become uninsurable, so we should be open to adjusting building codes to make sure new houses aren't being constructed in locations prone to flash floods or eroding coastlines. And this is why I'm very happy that together with DG Climate of the European Commission and the European Investment Bank, EIOPA was invited to particularly discuss this topic, how do we build in Europe in the next year. I'm going to conclude. At the beginning of my speech, I mentioned Hans Rosling and his book about factfulness. And in it, he argues that humans routinely belittle the progress we have made, even when the data shows the opposite. He urges people to shake off the pessimism, be a possibilist. And a possibilist, he says, is someone who neither hopes without reason, but also doesn't fear without reason. And with regard to climate change, we have reasons to fear, but we also have reasons to hope. Fear, because if we continue with the practices of the past 200 years, we will clearly drive our ecosystem to the brink of collapse. But also hope, because of the realization that we must do everything, and we are not yet doing everything, within our power to turn the tide around. And insurers have a monumental role to play. They can inform societies, incorporate the risk, invest funds, and incentivize consumers towards more resilient behavior. We are here to support for that. We on this endeavor with data, with modeling, with research, with surveys. And in that way, I truly hope that we can turn away from pessimism and start dealing with the problem. Thank you very much for this time, and I'll give the floor back to you, Carol. Thank you.